Good afternoon, everybody. Why don't we go ahead and begin the call? For those of you who I have not met during my recent visits throughout Asia, my name is Norman Villamin, and I serve as the Chief Investment Officer for UBP's wealth management business globally. Before we get started, I just wanted to walk very briefly through an agenda for the call. I expect that prepared remarks should last about 15-20 minutes. I'm going to begin by covering some of the most commonly raised questions from some calls that I've had with groups of clients around the world. First, focusing on what's happening in the global economy in light of the virus. Secondly, what we think needs to be done by policymakers to stabilize the situation. And then thirdly, given the fall in markets to date, how much is already in the market? And what should we expect going forward? And then after that, my colleague in Singapore, Paras Gupta, who's the head of UBP's discretionary portfolio management teams in Asia, is going to follow on and walk through steps we've taken in managed portfolios to navigate this unprecedented volatility we've seen in markets since January. So to kick off, focusing on what's happening right now, even though the focus is rightly on the coronavirus and the human impact it's having on communities around the world, what makes this episode of volatility different than ones we've seen in recent years is, in fact, this is a series of shocks to the global economy rather than a single event. The way we're thinking about it is what we've morphed from is a single, or started as a China-centric demand shock, which was expected to be contained much like the 2002-2003 SARS episode was. However, as we now know, the infection has transformed into first a global demand shock in the past months. In Europe and the U.S. in particular, it's morphing again, infecting now global credit markets, where we're seeing dislocation in those markets very significantly, and risking a broader global credit shock. And what is less recognized, but starting to come into focus for market watchers, is the prospect that this transforms into a U.S. dollar shock, effectively a shortage of U.S. dollars in the system, especially outside of the U.S. Recent moves by the Federal Reserve in particular to coordinate with European and Japanese central banks help to alleviate this pressure. But we're very much focusing on major emerging market central banks who are running short of dollars. And any type of relationship that the U.S. expands to provide new U.S. dollars to those central banks is going to be key to avoiding a U.S. dollar shock from taking hold in the global economy. Touching briefly on the infection situation in the U.S. and Europe, many people on the call will have a good sense of where we are in the process and what lies ahead for these two economies. But using the China and Asia experience, we believe we are now squarely in what we like to call the acceleration phase of infections in Europe and the United States. In Europe, more extreme social distancing measures have been implemented just in the past week outside of Italy, while in the U.S., those moves are beginning but remain piecemeal and not taking place on a national level. As a result, the risk is that with the measures and enforcement that remain short of what we've seen in places like China, Hong Kong, Singapore, or more recently Korea, or even with strict enforcement, the acceleration phase still continued for another 2 to 3 weeks. In Europe, and more so the United States, the risk is this phase may take longer, perhaps closer to what Italy has been experiencing over nearly the past month or so now. So looking forward, what needs to be done to stop this cycle from continuing? In light of a demand shock that is accelerating through the two largest economic blocs in the world, the European Union and the United States, containment measures are clearly the most important measures to end the acceleration phase in the weeks ahead. But on top of that, what we need to do and what we need to see from policymakers is to mitigate the demand shock that is rippling through the global economies. Primarily what we've seen from policymakers have been typical liquidity measures like rate cuts and quantitative easing. We think those announcements are necessary to keep money flowing through the economy, but alone they're not sufficient to address the nature of the problems facing the global economy. Beyond this, what we want policymakers to do, first, we think the U.S. in particular needs to implement a wide-ranging sovereign credit backstop for deteriorating credit markets. This is something similar to what we've seen indirectly in China and other countries in Asia, but more overtly recently in places like Germany and Italy. And as recently as this weekend, the European Union recently announced that they're going to help to prevent lenders from calling loans or cutting credit lines within the European economy. This move should buy time, in particular, for more robust containment measures to be implemented to slow the demand deterioration. It should also provide an opportunity for the demand shock from the virus to dissipate. And from an economic perspective, given the slow-moving fiscal policy measures that are being pursued, it will give them important time to move more aggressively to increase non-healthcare fiscal-related spending to shore up overall demand within the economy. Beyond this, we think, again, focusing on U.S. and Europe, European fiscal policymakers need to fill the revenue hole that's emerging, especially in small and medium-sized businesses, as well as household income streams. We think announcements of tax rebates are a start, but in Europe and the United States, where unemployment continues to be an issue, or underemployment, wide-ranging expansion of social safety net programs are going to be a big focus as well. This will also, once again, buy time for governments to prepare more medium-term demand measures like infrastructure spending or even debt forgiveness programs to ease the debt burden that is piling on both consumers as well as corporates once infection peaks and demand stabilizes. If we turn to markets, obviously markets have fallen very sharply over the last several weeks, certainly in the U.S., in Europe, and around the world. I know while most people like to focus on equity markets, we are increasingly focused on what's happening in credit markets to guide our thinking around the world. If we look at high yield spreads right now, even though they've widened very dramatically from over 300 basis points at the start of the year to now over 700 basis points, they remain just short of the 800 basis points we've seen in what we like to call a contained credit shock. This would be the scale of a Eurozone financial crisis, so very much a regional crisis, or even the 2015-16 energy sector shock in the United States. However, to put this into context, this is still well short of the nearly 1,000 basis point spreads that we saw during the early 2000 U.S. recession, as well short of the 2,000 basis points that we saw in the global financial crisis. In that sense, credit markets have yet to fully price even a full-blown recession in the United States or a widespread credit contagion around the world that we outlined earlier that is a concern. To avoid credit markets pricing this outcome, even if we are already in recession in many places around the world, again, we think governments will need to backstop credit markets like the European Union has overtly begun to do and the Chinese are doing indirectly through their state-owned banking system. If we look at global equity markets are showing similar pricing. We believe U.S., European, and Asian equity markets have to a large extent priced a contained credit shock. We may see another 5 to 10% down from here to price that more fully. In addition, if a full recession scenario or outright credit contagion occurs, a move to, for example, 2,000 on the S&P 500 would be consistent with previous recessionary episodes. I'm going to stop here in terms of looking at markets, and I'm going to pause and hand this over to Paras Gupta, who's going to talk about what we've been doing in portfolios in Asia to navigate this crisis.
Thank you, Norman, and good afternoon to everyone on the call. I'm going to just briefly take you through the positioning that we've had in our discretionary portfolios to give you a bit of perspective on how we had, in a way, prepared for a sell-off something like of the magnitude we're witnessing right now. In terms of our positioning, especially in our multi-asset class core discretionary portfolios, we had turned asymmetric over the medium term, and especially starting as early as 2018, mid towards the third quarter or fourth quarter of 2018, whereby our endeavor by asymmetry was to capture any upside in the financial markets that was available while trying to minimize the downside risks. Now, this approach was largely adopted bearing in mind the late cycle nature of the economic and business cycle, as well as the valuation of the financial assets that we were seeing. Now, what this meant at an asset class level within a multi-asset portfolio was that we were overweight alternatives, such as liquid hedge funds and gold, and we were underweight the conventional asset classes, such as global equity and fixed income. Now, talking a little bit specifically about equity allocation within the portfolios and how we built asymmetry. So wherever permitted by the individual client investment guidelines, we took a multi-pronged approach and strategies to build asymmetry. Firstly, we partially reduced our long-only equity exposure and instead increased exposure to long-short equity alternatives, thereby lowering the equity beta in the portfolio and instead focusing the portfolio towards more alpha-generating opportunities. Secondly, we also partially reduced our long-only equity exposure with short to medium-dated structured products with equity indices as underlying. The payoff in these structured products was such that they provided full upside participation to equity markets while limiting the downside exposure. And lastly, whenever volatility was cheap over the last year and a half, we would either tactically buy outright put options on equity indices to partially hedge our long-only equity exposure, or would replace funded long-only equity exposure by buying call options on equity indices. So as a result of these steps, our directional exposure to long-only equities early on in 2020 was close to 20% for a balanced multi-asset class portfolio, which has 50% strategic asset allocation to equities. So instead of 50% strategic asset allocation, we were tactically at 20% in terms of directional long-only equities. The remainder of our equity exposure was taken through the asymmetric strategies, which I just described. In addition to these steps, we had been increasing our off-benchmark exposure to gold in multi-asset class portfolios to build more resilience on the downside. As Norman alluded to in his remarks, that the recent sell-off has started to impact corporate credit asset class in a significant manner, we still continue to view gold as a relatively cheap proxy hedge to protect against a tail risk kind of an event. We are mindful of the crowded positioning in gold and the risk of a sell-off in gold due to margin-related liquidation as we are seeing right now, along with the two-way risks to the markets pose the significant sell-off that we have seen. We prefer to take further exposure to gold in an asymmetric fashion. Hence, we have bought upside call options on gold as opposed to adding outright exposure to gold. Overall, as I mentioned earlier, we continue to maintain asymmetry as a medium-term overlay in our portfolios, which was the key difference between us and the consensus. Even throughout 2019, we continue to maintain protection against downside risks while continuing to capture the upside. Of course, with the benefit of hindsight, downside protection was not required in 2019. However, the cost of having such protection was not significant back then and was more than mitigated by our strong security selection. This helped us perform in line with the markets and our peers in 2019 and actually outperform them on a risk-adjusted basis. In 2020, our asymmetric positioning in multi-asset portfolios have paid off significantly thus far and has helped us outperform the markets as well as most of our peers. We are now gradually starting to look to realize the alpha that we have generated through our approach. So I'm going to take a pause here and pass it back to Norman.
Thank you, Paras. To sum up, the situation right now in the United States and in Europe continues to evolve. We continue to see policy response moving, and as a result, we continue to expect to be very active in this risk mitigation effort that, as Paras outlined, focusing on asymmetric opportunities, managing risk to the downside, and participating in upside in markets should they emerge. We want to thank everybody and all of our clients on the call for your trust over the last few weeks and the last few months in these difficult markets. If you have any questions about what's going on, feel free to reach out to your private bankers or any of the investment teams throughout the region. I thank you for joining the call today.